Welcome to the Deep Dive. Today, we are immersing ourselves in what you might call the bedrock principles of successful investing. We're using a really classic source text.
Yeah, foundational one.
Exactly.
Yeah.
Our goal here is to cut through all the noise, the fans, and figure out what really makes an intelligent investor. And crucially, how to handle the emotional roller coaster that the market always seems to be.
And it's almost uncanny how relevant this material still is. It warned decades back that, quote, sooner or later, all bull markets must end badly. And we've certainly seen that happen. Think October 87 or the dot-com bust around 2000, 2002. Painful lessons.
Right, so these aren't tips for getting rich quick.
Not at all. This is about building real wealth that lasts, that can actually survive those market cycles.
Okay, so the market's always pushing us, trying to get us to react based on greed or fear in the moment.
Yep.
Let's break down the core ideas for success here. Where do we start? What actually defines the character of an intelligent investor? Because I'm guessing it's not about having a PhD in finance.
That's absolutely right. The source couldn't be clearer on this kind of intelligence. It's got basically nothing to do with IQ scores or, how you did on your SATs.
Okay.
It's a trait, more of the character than of the brain, as the source puts it.
More character than brain. Okay, let's unpack that. If it's about character, what traits are we talking about? What should people focus on developing?
Well, number one is patience. You need discipline and a real eagerness to learn constantly.
Right.
And maybe the most important part, you need the emotional strength, the fortitude to actually use those traits, to harness your emotions and think for yourself.
Instead of just following the herd.
Exactly, not just running with whatever the crowd is doing this week. That emotional discipline, that's really what sets people up for long-term success.
And that control gets tested immediately, doesn't it? By the temptation to speculate. People throw around investing and speculating like they're the same thing, but this source draws a really sharp line. Why is that distinction so critical?
Because, honestly, confusing the two is how most people end up losing serious money. The principle. The definition of investment here is very specific.
Okay, what is it?
It's an operation which, upon thorough analysis, offers safety of principal and a satisfactory return. Safety first, then return.
Safety first. And that thorough analysis part, how deep does that need to go? What does thorough mean in this context?
It means really understanding the asset you're buying, its fundamentals. If an operation doesn't pass that safety test based on analysis, it's speculation. Or, basically gambling.
So things like buying on margin.
Definitely speculation. Or jumping on a hot stock just because everyone's talking about it and the price is soaring.
Yeah.
That's speculating on price momentum, not investing in value.
Right.
Now, the source admits speculation can be fascinating. It can be a lot of fun while you are ahead.
Sure, winning feels good.
Of course. But the advice for the intelligent investor is crystal clear. If you want to speculate, fine, but use only a small amount of your capital. Put it in a completely separate account.
Ring fence it.
Exactly. Keep it totally separate from your serious long-term investment capital. That way, the risk is contained.
It makes you wonder, though, if this careful analytical approach is the key, why does it feel like Wall Street is always pushing the speculative stuff, the excitement, the quick trades?
Well, yeah, that's kind of the uncomfortable truth, isn't it? The source points out that Wall Street tends to downplay the durable virtues of investing and hype the gaudy appeal of speculation.
Why, though? What's the incentive?
It's pretty simple, really. Investors who buy and hold, who focus on dividends and long-term value, well, they make money for themselves.
Okay.
Speculators, on the other hand, with all their frantic buying and selling, chasing the next big thing, they generate a ton of commissions and fees. They make money for their brokers.
So the incentives aren't always aligned.
Often, they're directly opposed to what's best for the individual trying to build wealth carefully. It's a fundamental conflict.
That's a really important point. Which takes us nicely to maybe the most powerful tool for fighting back against those misaligned incentives and our own emotional impulses.
Yeah.
The famous parable of Mr. Market.
Mr. Market. Yes, he's like the embodiment of the market's irrational mood swings. A brilliant way to think about emotional discipline.
So explain the analogy. He's your business partner, right? In every stock you own?
Sort of, yeah. Imagine you co-own a private business with this guy, Mr. Market, and he's manic depressive.
Okay.
Every single day, he knocks on your door. Every day. And he offers you a price. He'll either buy your share of the business or he'll sell you his share.
But the price changes wildly.
Completely. Some days he's ecstatic, thinks the business is worth the moon, and quotes you a ridiculously high price. Other days, he's panicked, utterly depressed, convinced the sky is falling, and he'll offer to sell his share or buy yours for next to nothing. He's driven entirely by his mood of the moment.
So facing this every day, what's the intelligent investor supposed to do? How do you deal with this guy?
Your job is actually pretty simple. You ignore him most of the time. You just let his mood swings wash over you.
You don't have to trade just because he offers.
Absolutely not. You only pay attention when his price quote is clearly out of line with the real value of the business and it's to your advantage. So you buy from him when he's irrationally depressed and selling cheap.
And maybe sell to him when he's wildly optimistic and offering a crazy high price.
Exactly. The rest of the time. You focus on what actually matters. The dividends the business is paying you and how the business itself is actually performing its operating results, not Mr. Market's daily whim.
So the key insight here is that these daily, sometimes hourly price swings, they don't really mean much unless they offer a clear opportunity.
Precisely. For the true investor, price fluctuations have only one real significance. They create chances to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. That's it.
But we know that's incredibly hard to do in practice, right? Ignoring Mr. Market when he's screaming fire or FOMO when he's yelling euphoria. Our own biology works against us.
It really does. It comes back to that character over brain idea. Neuroscience backs this up pretty strongly. Studies show the pain you feel from a financial loss. It hits you psychologically more than twice as hard as the pleasure you get from an equivalent gain.
Twice as intense, wow.
Yeah. That feeling, that pain processed in the amygdala, the brain's fear center, it often causes people to panic and sell right near the market bottom, or it makes them too scared to buy more when things are genuinely cheap.
So your gut reaction is often the exact wrong thing to do for your long-term wealth. It's a constant battle against yourself.
It truly is. And the source has this fantastic line. It suggests the average investor would be better off if his stocks had no market quotation at all.
If you just couldn't see the price every day.
Exactly. For he would then be spared the mental anguish caused him by other person's mistakes of judgment. If you didn't see Mr. Market waving his crazy prices around daily, that emotional trigger to sell low wouldn't even exist.
That's profound. Turn off the ticker, get richer, and maybe sleep better. Okay, so that leads us to the ultimate defense mechanism, the concept that protects you from Mr. Market, maybe even from yourself, the margin of safety.
Yes. If you had to boil down the entire secret of sound, successful investing into just one single phrase, that would be it. Margin of safety.
Okay, define that for us. What is this crucial buffer, technically?
The margin of safety is simply the difference between the price you pay for a security and its underlying conservatively estimated intrinsic value.
So value versus price.
Exactly. It's that cushion, that buffer, that allows your investment to survive if things don't go exactly as planned. If there are unexpected negative developments, or even if your own initial analysis was a bit off, which, let's face it, happens.
How did this work historically? Can you give an example from when the idea was first really taking hold?
Sure. In the early days, a common approach was looking at earning power relative to interest rates. For example, if a stock's earnings represented, say, 9% on the price you paid, and at the same time, a safe, high-grade bond was only yielding 4%.
Right.
That difference, that 5%, was essentially your average annual margin of safety on that stock. Now, if you did that across a diversified portfolio, maybe 20 or more stocks, each with a similar cushion,
the overall portfolio becomes much safer.
Highly probable to achieve successful results over time, yes.
Oh.
The buffer protects the whole group.
And the source talks about a specific type of bargain hunting that really exemplifies this margin of safety concept perfectly.
Ah, you mean the field of undervalued or bargain securities?
Yes.
The classic, most clear-cut example is finding a common stock that's selling for less than the company's net working capital alone.
Net working capital. That's
Sure.
current assets minus all liabilities, right?
Yeah.
Like cash, receivables, inventory.
Exactly. After you subtract all prior obligations, debt, preferred stock, everything. If the market price is below that liquidation value of just the current assets.
Wait a minute. So you're saying the price is so low, you're essentially getting the company's fixed assets, its factories, equipment, real estate, maybe even its brand or goodwill for free.
Precisely. You're paying less than the value of the easily sellable stuff, the working capital, the hard assets, the ongoing business value. That's your massive margin of safety baked right into the absurdly low price. These are often called net nets.
Wow. That connects to something I remember reading about Graham's most famous student, Warren Buffett, flipping the script on risk and reward.
That's a great connection. Buffett often talked about how, in true value investing, the relationship is inverse. He'd say something like, buying a dollar bill for 60 cents is actually riskier than buying that same dollar bill for 40 cents.
How is cheaper riskier? That sounds backwards.
Because at 40 cents, your potential reward is much greater and your margin of safety is much wider. If you're slightly wrong about the value, you're still likely okay. The greater the discount, the lower the real risk of permanent loss.
Okay, that makes sense. So the bigger the potential upside, the less the actual risk. Because the safety margin is so large, that really is the core takeaway, isn't it? You can't be perfect. Mistakes will happen.
Absolutely. The intelligent investor shouldn't obsess over the probability of making a mistake. Because over an investing lifetime, that probability is basically 100%. You will make mistakes.
So what should the focus be?
Controlling the consequences of being wrong. That's where the margin of safety does all the heavy lifting. It limits the damage when your judgment inevitably falters.
Which brings us to a kind of philosophical conclusion, doesn't it? This idea of applying the safety margin. It sounds a bit like Pascal's wager.
That's a fascinating way to put it, yeah. If you consistently act with caution, always demanding that margin of safety, you might miss out on some quick speculative gains, sure, but you're essentially insuring yourself against catastrophic loss.
And the flip side.
Well, those who ignore the margin of safety, the ones chasing hot tips, betting the farm on something without a safety cushion, they are, in a sense, taking the wrong side of Pascal's wager. They're risking total wipeout, the permanent destruction of their capital, for maybe some short-term excitement.
A bad bet in the long run.
Yeah.
So wrapping this up, if someone listening feels like, okay, I get it, but I don't have the skill or maybe the time or the emotional wiring to do this deep analysis myself, what's the one thing they absolutely must do?
Even if you decide to hire professional help, an advisor or manager, there's one crucial responsibility you absolutely cannot delegate.
Which is?
You must do your own due diligence on that advisor. Thoroughly investigate them. Are they trustworthy? Are their fees reasonable? Do their actions align with these principles we've been talking about?
So verifying the character and competence of your advisor before handing over your money.
Yes. That responsibility for choosing wisely and providing oversight, that stays with you. Never, ever delegate that.
That's a really powerful final thought to leave everyone with, because ultimately, while the market does its thing, it's your own character, your discipline, and your commitment to that margin of safety that you truly control. Thanks for joining us for this deep dive.